Okay, it is 1:30, so we'll go ahead and get started. We have a few introductory slides, so if there are people that are still trying to connect, this will give them a chance to do so. Welcome to an In Training webinar from In Alliance. My name is Darius Breka. I'm a principal with the company, and for those of you that are not familiar with In Alliance, we are a small consulting firm in Central Illinois, and we specialize in historic preservation-based downtown revitalization projects. Today's topic is or are federal tax credits for building rehabilitation. But before we delve into the subject, I have a few housekeeping items to go over. Because we're using the GoToWebinar format, you'll be able to connect either through the mic and speakers of your computer or via telephone, and so you should have a dashboard on your screen that will allow you to do that. Furthermore, you'll be able to ask me questions. I can't guarantee that I'll answer them, but I will do my best. So there are several ways in which we can participate. You can type them into the questions box at any moment. You can also raise your hand in a sort of a classroom fashion. To be frank, I would prefer that you type the questions in order to stay on time. I'll probably address any of your questions at the very end of the presentation. Furthermore, the webinar is being recorded, so when it's finished, you will receive a link to the recorded version as well as a link to a brief survey that we would really appreciate that you answered, so we can make these future webinars as useful as possible. We're also looking for additional topics that you think may be useful for us to address in the future. But without further ado, today's topic are federal rehabilitation tax credits, and those are one category of four that I've identified of financial incentives that are available. There are local incentives, there are low interest loans and grants, but federal tax credits are the topic of our webinar today. They are the most widely available since those are federal programs. Everybody has access to them. Furthermore, they're not competitive as grants would be, for example. So as long as applicants meet all the requirements or criteria, the tax credits will be awarded. And so from that standpoint, it's a very reliable incentive, and federal tax credits have been a part of thousands of projects throughout the country since they were introduced many years ago. And so the tax credits that we'll cover today are the 50% tax credit, the 10% and 20% tax credit. And I should mention that depending on the credit, they're not just for historic buildings. They can be used for existing buildings or both. So, but they are generally not for new construction, and they involve existing buildings, whether they have an official historic designation or not. A few general principles regarding tax credits. They are applied to an owner's federal income taxes that are owed at present, or they can be applied to future tax liabilities, so they can be carried into the future. Eligible owners may be individuals or businesses as long as they pay federal income taxes. And the general principle of a tax credit is that it is worth a percentage of the renovation cost. So for example, if you're taking advantage of the 20% tax credit and you've invested $100,000 into the project, that will result in a $20,000 tax credit towards your federal income taxes. And so if it's a 10% tax credit, it would be $10,000 and so on. And also, regarding all of these tax credit programs, there is this clause of a denial of double benefit. So conventional wisdom is that a tax credit which reduces the amount of federal income taxes that you owe is better than a deduction which reduces the amount of taxable income. And most of the time that is true, with the exception of an instance when a deduction may put you in a lower tax bracket. So you really have to evaluate this on a case-by-case basis. But traditionally speaking, a tax credit is going to be beneficial, more beneficial than a deduction, I should say. And so the denial of double benefit is basically means that you have to pick. You can either take a credit or a deduction, but not both. So there is unfortunately no double dipping. I wanted to put this up here because I'm not an accountant, and the information that I'm providing to you is accurate to the best of my knowledge, but you should always consult your accountant or a tax attorney. So please don't go apply for federal tax credits as soon as this webinar is over. Please always consult your accountant, and you'll need to do that anyway because they have access and know certain figures that you'll need to know yourself before you can apply for the tax credits. So the first tax credit that we'll discuss today is the 50% disabled access tax credit. It is for all existing buildings. They don't have to be historic, and the credit applies to all of those instances. It does not work for new construction. This 50% tax credit is available for small businesses, and small businesses in this instance are defined as having less than $1 million in gross receipts or fewer than 30 full-time employees, and you always look at the preceding year in order to determine those figures. The tax credit is available for handicapped accessibility improvements, which means that any of these items that are listed here, ramps, restrooms, elevators, sidewalks, walkways, or widening of entries or interior circulation, hallways, those kinds of things, all of those things are eligible expenses for the tax credit. Now, the work does must meet ADA standards. ADA stands for American with Disabilities Act, and so that's one criteria that has to be met. Additionally, there is a minimum and a maximum amount for eligible expenditures. So the minimum that you have to spend is $250, and the maximum that's allowable is $10,250. So that $250 you just take away automatically, and since it's a 50% credit, the maximum that you can get per year is $5,000. Excuse me. And that's per year, which means that the credit can be taken annually. And the reason why this is useful is, consider a larger project such as installing an elevator, which is much more expensive than $10,000, and it would be useful to maximize the credit. So if you can coincide your work on these larger expenditures at the end of a calendar year and in the beginning of the following year, you can take $5,000 of credit for each year. So for example, continuing with our elevator example, you could install the shaft for the elevator in December and get $5,000 of credit for that, and then when you purchase the cab in January or February but the following year, you can again take the $5,000 maximum for that following year. So that's something useful in a way to perhaps utilize in order to maximize the credits. The credit can also be taken with other tax credits. So since we'll be discussing the 10% and 20% tax credits, this is another strategy to maximize and get the most for your investment. As an example, if you were to take the 10% tax credit, which is obviously much less lucrative than the 50% credit on your project, but the project involved expenditures that qualify here, so related to handicap improvements, you could separate those costs, those applicable costs, and take the 50% credit on those qualifying expenditures, and then take the 10% on the remainder of the work. You do have to be careful in instances when, if you remove those costs, that would then put you or disqualify you in terms of meeting the financial thresholds for the other tax credits. So once again, you do have to evaluate that on a case-by-case basis. The program, this particular tax credit, is super easy to take. It is administered entirely by the Internal Revenue Service, and there is no review whatsoever by a State Historic Preservation Office or the National Park Service, and it is just a one-page form on the IRS website with one-page instructions. It's amazing that anything that they put out would be so concise, and here's one instance of it. So Form 8826, very simple and easy. It's a very underutilized credit. It's probably because people don't know about it too much, but that's all it takes is one-page form. You fill it out, send it in, and you're done. So I do encourage people to take advantage of that one. I do want to mention that there is another program. There's a deduction option that you can utilize on this same form. It's called the Architectural and Transportation Barrier Removal Deduction, which is $15,000 per year. Everything else is the same. So essentially you have an option of either taking the 50% tax credit of up to $5,000 per year, or a $15,000 deduction per year. And once again, the form and the instructions are available on the IRS website. The next tax credit I want to talk about is the 10% rehabilitation tax credit. It is for non-historic buildings built before 1936. Non-historic buildings are defined as not listed in the National Register of Historic Places. That would be not individually listed in the National Register. If the resources are in a National Register district, they would have to be non-contributing. So when you're in a National Register district, your property is either contributing or non-contributing to the historic significance of that district. If a building is contributing, you cannot take the 10% tax credit. You only qualify for the 20%. So in that sense, the two credits are mutually exclusive, and I will talk about the 20% when we're done with this one. The 10% tax credit is available for income-producing commercial depreciable properties. And all sorts of uses are allowable with the exception of rental residential. And owner-occupied housing, obviously being non-commercial, is also not eligible. Eligible costs for the 10% tax credit include architectural and construction costs, and also depreciable soft costs, and those may include architectural and engineering fees, survey fees, legal fees, development fees, and other construction-related costs. Ineligible expenditures include acquisition costs, furnishings, new additions, or landscape or site improvements. So basically, and this is the same for the 20% tax credit, it's only work that is spent on the footprint of the existing building itself. So an addition would not count and again, landscape or site improvements would not either. And then furnishings, because they can be moved or taken away from the building, also wouldn't be eligible. But almost everything else does count and is eligible. Furthermore, for the 10% credit, the building must pass a physical retention test. What that means is that 50% of exterior walls must remain in a building. There are 3 criteria. All of them have to be met. So the first one is 50% of exterior walls must remain. The second is that 75% of exterior walls must remain as exterior or interior walls. And the third is that 75% of the building's internal structure must remain. Now, all of this is designed to ensure that when you're done rehabbing that existing building, it still is an existing building and not an entirely new building. So even though this is for non-historic buildings, it still needs to be an existing structure by the time you're done. And so those are the thresholds that must be met. There is a minimum financial amount or investment that has to be spent. These tax credits are for substantial rehabilitations, and substantial rehabilitations are defined as having expenditures of $5,000 or the adjusted basis of the property, whichever is larger. And you have a 24-month window to make that investment. The adjusted basis is defined as purchase price, and then you subtract land value from that, you subtract annual depreciation, and you add in any capital improvements. So you're basically trying to figure out what the amount that is the worth of the building itself. So if you've owned the building for 30 years, for a long time, the adjusted basis is going to be pretty low. If you've just purchased it, it's going to be the purchase price minus the land value. So that's a rough formula for adjusted basis. Now this credit, relatively speaking, is also very easy to take because just like the 50% tax credit, there is no review by the State Historic Preservation Office or the National Park Service. And the form that's applicable here is Form 3468 on the IRS's website. And again, it's very simple. The form is slightly longer than for the 50% credit, and the instructions are only slightly longer, but all in all, it's a very, very easy tax credit to take. So you have to maintain everything that you do to auditable standards, obviously, but there really isn't a review. So, you know, you submit all of your information to the IRS, and they will believe you, or they may choose to audit you. But outside of that, nobody's going to come to you and check that you've that you did what you said you were going to do. So, very easy tax credit to take. And the last tax credit that I wanted to talk about is the 20% rehabilitation tax credit, which is for certified historic structures, for historic properties. And these are defined as listed in the National Register, so either individually or as a contributing building within a National Register district, or as contributing buildings within a local historic district certified by the National Park Service. There aren't that many local historic districts certified by the NPS, so most of the time, vast majority of the time, it's the first option that's going to apply. There are many similarities between this one and the 10% credit. The 20% credit is also for income-producing properties, and all of the eligible uses are the same with one exception. This one does allow for rental residential as an eligible use, so that's the one major difference between this and the 10% tax credit. Owner-occupied housing as a non-commercial, non-income producing use is still not an eligible expense. Eligible costs are the same as for the 10% tax credit, so any architectural and construction costs and depreciable soft costs count, and ineligible expenditures such as furnishings and site improvements are also the same. They do not qualify. The financial trigger is also the same. You have to spend the $5,000 or the adjusted basis during a 24-month period. That's the standard option. Now, with the 20% tax credit, there is an option to go for a 60-month phased project. And the reasons that you might want to consider that is, well, in addition to having more time to complete your project, you can also take the credit for each phase once it's finished. So normally there is a three-part application process, and I will get into that in just a second. But in a phased project, you would do that. You would submit parts 2 and 3 for each phase. And again, once you finished with the phase, a phase could be exterior work, and second phase could be interior work. So as soon as you finish with exterior, you can take the credit on that amount, and then you can proceed with working on the interior, and then you would take the credit for the remainder of the work when that's finished. So so it's a good option to have. Now, in order to qualify for that option, you do have to know what your phases are going to be in advance of the project, and you are encouraged to have good plans and those kinds of things in advance. So they don't like to kind of see too many deviations from the plan once you're in a phased project. So you have to know pretty much everything that you're going to do. However, the phases don't have to be so specific. Again, they have to be they could be exterior or interior work, just as vague as that. So if you know your project's going to take longer than 2 years, why not go for that? There is a major caveat that the project must meet the Secretary of the Interior standards for rehabilitation. To me, in my professional opinion, the standards are not a big deal because they're really common sense rules for dealing with historic buildings. And the principle here is that if you're going to utilize taxpayer funds, because that's what's funding the tax credit, then you should do something in return. And what you should do in this instance is make sure that you do good things to that historic buildings, that you don't butcher it or change it so its character is no longer recognizable. There is a three-part application that is reviewed by both the State Historic Preservation Office and the National Park Service. So there are 2 levels of review in this process. I'm not going to get into the application process so much. The part 1 is the evaluation of significance. Part 2 describes the work that you're going to do. And then part 3 essentially shows that what you did what you said you were going to do. So it's proof that the work was completed. But the very important point about part 1, this evaluation of significance, is that it must be submitted prior to placing the building in service. It absolutely must. There are several of these critical components regarding the 20% tax credit, but this one, there is no going back with this one. So if the part 1 is not submitted, then the IRS will interpret that you did the work on a non-historic building, because part 1 certifies that the building is a historic structure. So the building doesn't become a certified historic structure until the National Park Service determines that through the Part 1 process. So again, if you've put the building base, if you placed the building back in service, and you've submitted the Part 1 afterwards, the IRS is going to deny you the tax credit. So that's something that really needs to be done. If you know you're going to take the tax credit or you have an interest, just submit the Part 1 and then worry about everything else later. Individually listed buildings do not need a Part 1 because they're already certified historic structures through the National Register listing process. But if they're in a district, they have to be certified by the Park Service through this tax credit process. Another caveat or another requirement, there is a sliding fee for the review that the National Park Service charges. So if your project is $20,000 or less, there is no fee. If it's, or I should say, if it's less than $20,000, there is no fee. If it's $20,000, then there's a $500 fee for review, and then it incrementally gets larger until it maxes out at $2,500 for a project of $1 million or greater. So the most that you would pay is $2,500. Additional caveat is that the owner must retain the building for 5 years or return a prorated portion of the credits. So, and it's 20% of the value of the credit per year. So if you got $100,000 in tax credits and you sold the building after 2 years, then you would have to pay back $60,000 as an example. Because you're dealing with the State Historic Preservation Office and the National Park Service, and each has a certain amount of time to respond, approval of proposed work does take several months. The less organized, the less prepared you are for this process, the longer it's going to take, because they can request more information almost an infinite number of times, really, and that is going to stall the project and create it's going to slow you down. So you must be aware that this is a bureaucratic process. There is no reason of no way of getting around it. But if you know that going in, then you can be prepared that that's what it's going to take, and you have to deal with it. And for that reason, it is strongly recommended that applications are filed before work begins, because there is this issue of the standards. So if you already began doing work and you did something insensitive to the historic structure, then you may be denied the tax credit. So it is strongly recommended that that you consult your State Historic Preservation Office right away before you do anything to the building. Now, having said that, there are countless of examples of projects coming in after they were already completed, right before they were placed into service, because that Part 1 does have to be sent in before that. But obviously the best ideal case scenario is that the tax credit application is filed before you start the work. And as a former staffer at Illinois Historic Preservation Agency who reviewed tax credits, I do concur with that recommendation. Once again, please consult your accountant. What I've outlined to you here today is very basic, preliminary information, but there is much more that needs to be evaluated on a case-by-case basis, and if you consult your accountant, he or she will set you on the correct path. I do want to mention a couple of useful links. The IRS's website has all of these forms that I mentioned and instructions, so they're all downloadable, so that's a very good resource. And the National Park Service website discusses both the 10% and 20% tax credit, but furthermore it discusses and has numerous examples regarding the standards, Secretary of the Interior standards for rehabilitation, and the National Register program. And since all of these programs are interlinked and necessary for the tax credit programs to occur, this is just a great one-stop shop website to get all of that useful information. So that concludes the information portion of the webinar, and I just wanted to quickly promote our upcoming trainings before I answer any of your questions. On May 15th, I will continue to discuss the 20% tax credit. We've kind of touched on the basics, but we didn't really get into the application process or the Secretary of the Interior standards, so we're going to recap what we talked about today about the 20% credit and go into much more in depth regarding the various nuances of the program. So on May 15th, we'll have a full half hour on the 20% tax credit. On May 22nd, Todd Tracy from An Alliance will discuss how community-based programs can attract youth to an entrepreneur program. And then on June 5th, Todd once again will speak about the importance of mentoring in developing successful youth entrepreneurs. So the information and registration information about these webinars is available on our website at inalliance.biz/intraining. So with that, I want to thank you for attending the webinar, taking the time from your busy schedule to attend the webinar. Hopefully you found it useful, and now I'm going to go to the questions pane in my overly complicated GoToWebinar dashboard and see if any of you have any questions. So looks like there are several. Question, is the 50% disabled tax credit something that can be transferred or sold by an owner to another building business owner? That would be a question for an accountant. My belief is that the 50% credit is not eligible for that. Same thing for the 10%, but there is an option, although albeit somewhat difficult, to do that with the 20% tax credit. The transfer of tax credit or syndication of tax credits, it's done much easier with state tax credits. They have much less legislation, and that's typically the major difference between federal and state tax credits. State tax credits tend to be structured so that can be done much easier. The 20% tax credit, it's possible to syndicate, but the amounts of credit and therefore the amounts of projects have to be much larger in order to make it worthwhile to get to pay for all the legal fees that that are involved with structuring that kind of a deal. So I'm fairly certain that the 50% and 10% are not eligible for those kinds of transfers, but I will look into it. A question about what does putting the building in service mean? It's essentially completing the project, and because we're talking about commercial uses, it's putting it back into commercial service. So if a business opens, if there is income producing activity in the building, it is put back into service. Typically, a indication of that is when you receive your certificate of occupancy. That means that the building is put back into service. Let's see. Another question. At one time, the banks used to buy the tax credits at a rate of 85 cents on the dollar. Correct. That's the syndication process that we were talking about, and that market has kind of tapered off right now. But again, it's much easier to transfer and sell state tax credits, and being in the state of Illinois, I'm sorry to say that is not something that's available now in this state. It is something that people are working on. And another thing to mention about the 20% tax credit is that even though there seems like there are some headaches to deal with, because many states have state tax credits and those are much easier to take, and all of the requirements are essentially the same. So if a project qualifies for the federal tax credit, it will automatically qualify for the state tax credit. That really is a reason to bother, so to speak, with the 20% credit, especially in instances when state tax credit is available, because you're doing all of that work not for the 20% tax credit, but 20% plus another 20%, or maybe even a 30%, whatever the value of the state tax credit is. Just a couple more questions here. Looks like, is adjusted basis just another way of saying assessed value of building minus the land, or is it substantially different? It's not the assessed value. It's the and it's its own thing, and accountants must know that figure. Again, I'm not an accountant, but an accountant needs to know that figure to do property taxes for your commercial property every year. So roughly that formula that outlined, that's what adjusted basis is. It's because you do have to factor in depreciation and capital improvements. So assessed value is somebody's guesstimate about the value of the property. The adjusted basis is a much more precise number. Okay, I think I answered all of your questions, but if I did not, you can feel free to contact me at your convenience. My contact information is up on the screen. Once again, thank you for your time today, and you will receive a follow-up email with a link to a brief survey, and as well as a link to a recorded webinar, which I hope you can share with people who may find it of interest. So without further ado, thank you very much, and enjoy the rest of your afternoon.